Do you have difficulty understanding what the various stock market order types are and what they mean? I know I did when I first started out with trading. So I have created this short video to help you understand what are the various type of orders, what they mean, and when it's best to use them. So there are four main types of order types: market order, limit order, stop order, and stop limit order. Let's go through each one of those and I will explain what each means. A market order. A market order is simply a buy or sell order that is executed immediately at the current market price. As long as there are buyers and sellers available, market orders are filled. So if you want to simply buy or sell shares at the current market price and you don't care if you get the best or cheapest price for it, you would use the market order. It's pretty straightforward. A limit order. A limit order is an order that is executed when the price is above or below a specified price. And I will explain soon. There are two types of limit orders: buy limit order and a sell limit order. A buy limit order. A buy limit order is an order that is executed only when the price is at or below a specified price. Meaning, if you believe the price will come down to a certain price level and then will rise, as we can see in this diagram, then you would use the buy limit order. When the price reaches the set limit price or below it, your order will be executed. This is the set limit price right here, is the red dotted line. If the price will go below it or at it, then the order will be executed. Now alternatively, you can use the buy limit order instead of a market order to get the cheapest possible price by setting the buy limit above the current market price. So if we raise or if we set the buy limit above the current market price, then we will automatically or immediately enter into the trade, or the trade will be executed immediately. The alternative to the buy limit order is a sell limit order. It is an order that is executed only when the price is at or above a specified price. If you predict that the price will rise and then fall, then you can set the sell limit price to the price you predict it will reach before it will fall, and that way you get the best possible price executed. You can use also the sell limit order to place a take profit target, meaning if you believe that the price will come up, or you're in a trade, in a position, and you will want to take profit at a certain level, you would use the sell limit order, and when the shares, when the price will reach that price, the shares will be sold when and if the price reaches above that set limit. A stop order is an order to buy or sell stock when the price is above or below a specified price. However, in a stock order, when the set price has reached, the order becomes a market order. That means that if the price hits the stop price, the order is guaranteed to be executed at the market price. You can use the stop order if you want to set a stop loss also, or if you want to enter above or below a certain price level. So there are two types of orders as well as in this case, the buy stop order and the sell stop order. Let's look at an example. A buy stop order. It is an order that is executed only when the price is at or above a specified price. So for example, if you want to enter above a resistance level or above a reversal candlestick, you would place the buy stop order at a price above that point and if the price reaches that level, the order would turn into a market order, guaranteeing an execution. Alternatively, we have the stop sell order, which is an order that will be executed only when the price is at or below a specified price. The sell stop order can be used also as a stop loss order to limit loss. If the price goes below the sell stop level that you set, then the shares will automatically be sold at that level or below it. Lastly, we have the stop limit order, which combines both the stop and limit orders together so that a trade is executed sequentially. As the name suggests, when a price reaches the stop value, the order becomes a limit order and it will only be executed if the price is above or below the limit value. So this means that this order is useful when you want to enter a trade only if the price is between a certain range, or when two conditions exist in order for it to be executed. As before, there are two types: a buy stop limit and a sell stop limit order. Let me explain by looking at specific order types. The buy stop limit order is an order that is triggered only if the price is at or above the stop price and is at or below the limit price. This means that when the price reaches the stop value, the order becomes a limit order. This is the price range I talked about in the previous slide. So when would we use this type of order? Well, mostly if we want to enter into a trade after market hours, but there is a chance that the price might gap up, and the risk is high for us. We want to minimize that by placing a stop limit order. The stop limit order will allow us to enter only within our set price range that is within our risk-reward ratio, and only if the price is within that we will enter. Lastly, we have the sell stop limit order, which is opposite of the buy stop limit order, and it will execute only if the price is at or below the stop price and is at or above the limit price. That's pretty straightforward. If you would like further information on this topic, where I go in much more greater detail and many other subjects, you can visit my website skillsofthetrade.com, which will be in the description, or get a copy of my book called Stock Trading 101, a practical beginner's guide to stock trading and technical chart analysis. You can get it on Amazon. I've designed this book for the visual learner in mind. It has over 130 color charts and diagrams where I will teach you how to read stock charts, what are the strategies that I use. You will understand risk management and much more. Check it out on Amazon or visit my website.